Day trading. For some, it sounds exciting. For others, it sounds overwhelming. But for those who take the time to learn the strategies, manage their risk, and follow a disciplined plan, day trading can become a powerful and rewarding skill. In this video, we'll walk you through everything you need to know about day trading. The key concepts, core strategies, important tools, and actionable tips that will help you build a strong foundation. Whether you're curious about what day trading actually involves, or you're ready to start refining your intraday setups, this breakdown will give you the real-world insights you need, without hype or shortcuts. Let's dive in. Day trading is the practice of buying and selling stocks or other assets within the same trading day, meaning you open and close your position before the market closes. You're not holding overnight. You're not looking for multi-day trends. You're capitalizing on short-term price movement, sometimes within minutes or even seconds. Day traders often use technical analysis, chart patterns, momentum and volume spikes, level 2, market data, and time and sales feeds. This is a fast-paced environment. You need to be decisive, informed, and above all, disciplined. Day trading may be right for you if you're able to watch the markets in real time during trading hours. You enjoy technical analysis and pattern recognition. You're willing to start small, practice with simulators, and grow your skills over time. You can manage emotions under pressure. You understand that it's not about getting rich quick, but about consistency and edge. It's not for people who want a passive or part-time system. Swing trading or investing would be better suited for that. Day trading is a profession, one that demands training, patience, and process. Before we explore specific strategies, let's get familiar with some foundational concepts. Liquidity. You want stocks that can be bought and sold easily without slippage. Volatility. You need price movement to profit. No movement equals no opportunity. Volume. Higher volume confirms conviction behind price moves. Risk management. You can't survive without defined stops and size control. Pattern recognition. Most setups rely on repeatable price behaviors. These concepts form the lens through which you evaluate every potential trade. Day traders rely on very short-term charts to make decisions. Most commonly, 1-minute chart for scalping and fast momentum moves, 5-minute chart for most strategy entries and setups, 15-minute chart for identifying short-term trends, 60-minute or daily chart for key support resistance zones. While you may zoom out for context, your decisions will often come from the 1-minute to 15-minute range. If you're trading with a US-based brokerage and have less than $25,000 in your margin account, you are subject to the pattern day trader rule. This rule limits you to 3-day trades in a rolling 5-day period, unless your account is above the $25,000 threshold. You can avoid this by using a cash account with no margin, but limited buying power, trading with offshore brokers with caution, focusing on swing trading until your account grows. This is a rule you must understand before beginning active day trading. Let's walk through what a typical day trader's routine looks like. Pre-market prep, 8 to 9:30 a.m. Eastern Time. Scan for gappers and high-volume movers. Review news, earnings, upgrades and downgrades. Mark key levels on charts. Choose a watch list of 3 to 5 tickers. Market open 9:30 to 10:30 a.m. Eastern Time. Highest volatility and volume. Execute first trades or wait for confirmation setups. Focus on 1 or 2 top names. Don't chase everything. Midday lull 11 a.m. to 2 p.m. Volatility often fades. Consider taking a break. Avoid forcing trades in choppy conditions. Power hour prep 2 to 4 p.m. Watch for reversals or trend continuations. Monitor volume picking up again. Enter trades with tighter stops and shorter time frames. Post-market review. Analyze trades. Log results in your journal. Reflect on what worked and what didn't. Day trading is about structure and repeatability, not random guesses. Let's break down 4 of the most effective strategies used by professional day traders. These are adaptable to many stocks and markets and form the foundation of a reliable day trading system. Opening range breakout. This is one of the most popular strategies for the first 30 minutes of market open. Here's how it works. At market open, 9:30 a.m. Eastern Time, wait for the first 15-30 minutes to form a clear price range. That range becomes your opening range, with defined high and low. A breakout above that range signals a potential long. A breakdown signals a short. This strategy works best with high-volume gappers, strong catalysts, or trending stocks. Tip: use VWAP or volume spikes to confirm momentum before entering. VWAP stands for Volume Weighted Average Price. It represents the average price a stock has traded at, based on both price and volume. Many institutional traders use VWAP as a benchmark, so it often acts as support or resistance during the day. Here's the setup. A stock drops below VWAP in the morning, then slowly climbs back. When it reclaims VWAP with strong volume, it often signals renewed buying interest. You enter long on the reclaim candle, with a stop just below VWAP. This is a great strategy during mid-morning when price action slows down and reversals develop. These are continuation patterns that occur after a strong move, followed by a consolidation. Bull flag. Price spikes up, pulls back slightly in a tight range, forming a flag. Then breaks out again, bear flag. Price drops hard, pulls back upward in a tight flag, then breaks down again. These patterns are especially reliable when combined with volume patterns, VWAP, or news catalysts. This strategy focuses on sentiment shifts. If a stock opens red, below yesterday's close, but reclaims that level and goes green, it often triggers momentum buying. If it opens green but reverses and goes red, it may trigger panic selling or shorts entering. Entry is at the moment price crosses yesterday's close with confirmation. Set your stop just below that level and manage risk carefully. These moves can be fast and powerful. There are two main styles of day trading. Scalping. Very short-term, 1-minute charts, small profits, high frequency, in and out within seconds or minutes. Momentum. Trading, ride a move for 5-60 minutes. Use 5-minute charts, fewer trades, larger gains based on breakout or trend continuation setups. Most beginners should start with momentum strategies. Scalping requires exceptional speed, execution, and risk control. Because day trading happens quickly, risk management must be built into every trade, not something you think about afterward. Follow these rules. 1. Hard stop on every trade. Place a physical stop loss in your trading software. Don't use mental stops. Emotions are too fast too. Max loss per day. Set a dollar or percentage limit for daily losses. Example, stop trading if you lose $200 in one day. Prevents revenge trading and emotional decisions. 3. Max number of trades. Limit yourself to 3-5 trades per session. Focus on quality, not quantity. 4. Risk per trade equals 1% or less. If you have a $10,000 account, risk $100 per trade. Max. Use position sizing to control exposure without strict rules. Even one bad trade can undo a week of progress. Emotional control is one of the hardest and most important parts of day trading. Here are key psychological tips. Accept that losses are part of the game, stick to your plan. Don't improvise under pressure, avoid FOMO. If you miss the move, wait for the next setup. Detach from money. Think in terms of setups, not dollars. Walk away after hitting max loss. Protect your mindset. Professional day traders act like pilots. Every trade is a checklist, not a gamble. Your edge is in consistency and control, not speed or luck. Every successful day trader keeps a detailed trade journal, and not just for tax purposes. Your journal is your mirror. It shows you what's working, what's not, and what needs fixing. Track the following: ticker, date and time of trade, entry and exit prices, position size, strategy used, reason for entry, emotions before, during, and after, what you learned. Review your trades weekly. Look for patterns. Are your losses coming from one type of setup? Do you make money in the first hour but lose it later? Are you following your plan or breaking your rules? This kind of structured review is how amateur traders evolve into professionals. Let's break down a conservative example. Say, you take 3 trades per day, you risk $100 per trade, you aim for a 1-2 risk reward, you win 60% of the time, you trade 20 days per month. Results: 36 winning trades, $200 profit each equals $7,200. 24 losing trades, $100 loss each equals $2,400. Net monthly profit equals $4,800. Now, let's be more cautious. Half those numbers, or reduce your win rate to 50%. Even then, you're still potentially making $2,000 per month, while staying within strict risk rules. The key is to start small, stay consistent, and compound your growth over time. Let's go over common mistakes that wipe out day traders. 1. Overtrading, taking too many trades without quality setups. 2. Chasing, entering late on a move due to fear of missing out. 3. No stop loss, holding a loser hoping it will bounce. 4. Over-leveraging, using too much margin or size for your account. 5. Trading without a plan, guessing instead of following a tested system. 6. Getting emotional, letting anger, fear, or excitement drive decisions. 7. Revenge trading, trying to get back money after a loss. Memorize this phrase: one bad trade should never ruin your day, one bad day should never ruin your month. Discipline protects your capital. Discipline builds your future. Let's review your daily structure as a day trader. Pre-market prep, 8 o'clock 9:30 a.m. Check news, gappers, and earnings. Create your watch list. Mark support resistance levels. Opening trades, 9:30 10:30 a.m. Focus on 1-2 top tickers. Use strategies like OR-B, VWAP reclaim, or red to green. Stick to your plan, no guessing. Midday, 11 o'clock 2 p.m. Be cautious. Consider stepping away or reducing size. Watch for consolidation and flags forming. Afternoon action, 2 o'clock 4 p.m. Monitor volume for late day moves. Use tighter stops. Avoid forcing trades. Post-market review, 4 o'clock 5 p.m. Log trades. Take screenshots, reflect, and reset. Day trading is a system, not a gamble. Day trading isn't easy, and it's not for everyone. But if you're serious, disciplined, and patient enough to follow a structured approach, it can become a powerful way to generate income, grow skill, and eventually scale. Start small. Learn from every trade. Protect your capital. Master your mindset. And always put process over profit. If this video helped clarify day trading for you, take action now. Hit the like button, subscribe to the channel, and share this video with anyone you know who's diving into trading. It helps the channel grow and keeps this valuable content coming your way. Turn on notifications so you never miss a deep dive breakdown, and get ready for the next big step in your trading journey. This video is for educational and informational purposes only. It is not financial advice, and we are not licensed financial advisors. All trading involves risk, and you should do your own research or consult with a licensed professional before making investment decisions. Past performance does not guarantee future results.